Joining us right now on stage at the Milken Conference, he's the president and CEO of Thornburg Investment Management, which has about $44 billion in assets under management. Jason, great to see you here.
Yeah, it's great to be here.
You having a good time so far?
I mean, it's interesting. It's an interesting conference for sure.
Interesting conference, and you're here, of course, on a day where we got the big Fed decision. I know you were paying attention to it. We got the 50 basis points that everyone seemed to think that we would get. As far as a potential 75 basis point hike going forward, Jay Powell seemed to throw cold water on that, and whatever this neutral rate is that we're aiming for, it appears we're still a long way off from that.
It's a magical rate. Yeah. It's in the Enchanted Forest, the neutral rate. But yeah, I actually expected 75 to be on the table. He took it off the table. I think the markets were pricing in very hawkish, and you couldn't out-hawk the market. So obviously the reaction in markets has been that this is a little bit more dovish.
Well, when you look at a market reaction like this, and obviously it's just one day, really just 1 or 2 hours here, but when you see a 3% move on the S&P 500 on the back of this year, does that seem like a sentiment that would be sustainable given what we know about economic conditions?
I don't think so. So you can go back to the last few Fed meetings, and a number of them were considered to be dovish, as this has been. And then the market reconsidered what the Fed's path might have to be, and ultimately that kind of disappeared, and we sort of returned to a hawkish rhetoric. So I think this is maybe just a bounce from what is sort of a buy the rumor, sell the fact kind of idea.
It was interesting, some of the commentary out of Powell during the press conference seems to suggest that there were some economic cracks. He's obviously been relatively upbeat, as you would expect the Fed chair to be, but he did seem to make it clear that there were some things that they were concerned about, things that might not necessarily be in their purview to solve via rates alone.
That's right. The Fed is talking about almost being overwhelmed by events. All these things are happening to us, and it's not our fault. But the reality is he was very clear that inflation is the mandate, and price stability is a precondition for employment. So that, to me, continues to be pretty hawkish. I think what they're looking at is some slowdown, the ISM, services, and manufacturing. But what they're really relying on is labor strength. That is the key for them, and that's the thing, actually, that they view as now a big contributor to inflation.
As a big contributor to inflation. When you look a little bit further down the road here, the potential for an economic recession, if not recession, maybe some sort of prolonged doldrum, if you will, is that in the cards, based on what you're looking at?
I think it's my base case expectation. The Fed,
for a recession.
Right, recession. And interestingly enough, for this group here, I was surprised to sort of, straw polling. Probably about 3/4 of the attendees here expect a recession. Now, they don't expect it to hurt them, but they expect a recession. I was amused to hear Jay Powell talk about going for a soft-ish landing. Not soft, but soft-ish.
Yeah.
I'm about to fly back to Santa Fe, and I also hope for a soft-ish landing, but I think it might be a little bit harder.
Well, you talk to your pilot when you get on it and see what he or she has to say. But in all seriousness, with regards to the idea of sort of making this soft landing or soft-ish landing here, even though he basically admits that Fed policies in the toolbox may not necessarily be sufficient to address some of these things, is there something else that could help? Is there fiscal policy? Is there something else within the government realm that could sort of maybe blunt the impact a little bit?
There are many things that could help. The Fed is clearly saying that's really not our job.
Right.
And so, okay, is Congress doing what they should do? But we're in a moment where we're removing liquidity, right? And we as a market are realizing, it was Barzini all along. We're realizing that liquidity is coming out of the system.
Right.
And in fact, that's also happening fiscally. But that's a good thing. We have outsized inflation. We're trying to get that down. So for sure, there's lots of dynamics, and arguably the Fed and fiscal were too much or for too long coming out of the pandemic. So yeah, there's a lot of interactions there.
But you're talking about normalization of policy, but it would also mean normalization for investors who have basically been operating off of a playbook for the last, decade or so now, where you had an ultra-accommodative Fed. Have you made adjustments to your strategy in anticipation of this?
Yes, I think that liquidity removal necessitates change in a thought process. Let me just give you a very simple example.
Sure.
We've been in a world where short-term cash pays zero for a really long time. Now, short-term cash went up today by 50 basis points, but not too much longer than that. You're talking about 2.5%, 3%. Now, I get that inflation is in the 8s, but that is a whole lot better than it's been. So the cost of holding cash and liquidity is going down. Therefore, people should and can hold more of it with less of that cost. That brings speculation out. That's the whole point of raising rates.
What do you think about holding bonds in this environment?
I think bonds now suddenly, and I mean suddenly, really, in the last couple months, went from being sucky to being less sucky. So what does that mean? it means that they have some income, not as good as inflation, but actually can start to provide some ballast. High quality fixed income can provide some ballast to your portfolio when it couldn't when it was below 1%. So now if you get a recession, you're going to see bonds rise in price. 2 or 3 months ago, you really couldn't make that call. And I think that's very valuable for investors.